I'm going to talk a little bit about, some of you may have heard some of this before, because it is a talk, or it's a subject anyway, that I've been talking on a little for the last few years, partly because of the very activity actually that is the subject of the talk, namely the work that's being done in the market to produce standardized documents or standard documents for use in the context of hedging, particularly the initiative that's being led by ISDA and IIFM, the International Islamic Financial Market, which is a project which we, and particularly me, we at Clifford and me, have been working on. Can everybody hear me, by the way? Okay, good. Okay. So let me start by making sure I can wear that. Yes, good. So I'm going to, towards the end of this, I'm going to just talk a little bit about exactly what's being produced, the documentation that's being produced, and and where we're going as well, a little bit on that project. But I wanted to start with a little bit of background. Again, many of you, I'm sure, are already very familiar with this, but we've seen, obviously, we saw the early stages of the Islamic derivatives market, I guess, in the mid-2000s. I mean, certainly there are examples of individual houses entering into derivatives products. Well before that, we worked on some ourselves, many years ago. So I'm not by any means suggesting that the mid-2000s is the origin of the industry, let's say. But what is clear is that around that sort of time, initiatives to look towards standardization began to start being talked about. In fact, about 2006, 2007, ISDA, who I imagine most of you, if not all of you, are familiar with ISDA, but the International Swaps and Derivatives Association, which is the association which in the conventional market has developed standard documentation, continues to do so, and many people in the market, because of the role of ISDA in the conventional market, approached ISDA in 2006 or 2007 and asked it to get involved in developing standard documentation for the derivatives market. And there were, I remember, some working group meetings in the early stages to sort of try and explore what was possible and what was out there and so on. And it took a little bit of time to get going, and I think part of it was really because, from ISDA's point of view, they've got the documentation experience and can access that. That I think they for their part were a little bit nervous about how are they going to address the Sharia side. And in a way, the solution, or a solution certainly, to that came in around 2007 when ISDA and IIFM, the Bahrain-based International Islamic Financial Market, an association as well, signed a memorandum of understanding, and they agreed on a number of projects that they were to work on together in that memorandum of understanding, and indeed, developing standard documentation, was at the heart of that. And in a way, the cooperation or the collaboration, the way it's worked, has been that, in a sense, from the ISDA side, the input has been the documentation experience, and the input from the IFM side in particular has been the access to, especially IFM's panel of scholars, which is if you go on the website and look, I mean, you'll see that the scholars that are on IFM's panel are very well-known scholars, very broadly representative, and so in a sense, what IFM was bringing to the collaboration was the Sharia side, which is exactly what ISDA had been concerned about how it was going to deal with. And I do think, from my own kind of participation in that it's been I think it's been even though slow on occasions and difficult to sort of progress, but over time I think we've certainly we've seen it achieve a lot of what it set out to achieve, and it's not over yet by any means, but certainly good progress has been made, particularly with, as indicated on the slide, in March 2010 the publication of the Dawood Master Agreement, the Islamic Master Agreement, which I will talk about shortly. And then, in fact, very recently, just 3 or 4 weeks ago, the publication of the template confirmations for profit rate swaps. The need for standardisation, I mean, in a way, there's nothing special in this sense, in this respect, about the Islamic market relative to any other market. All markets, so if you go back to the, go back to the time what Warren was referring to, actually was a point in time in the derivatives markets, where, in the conventional derivatives markets, where in fact standardisation was the very exercise that was being undertaken. And there was a suite of documents produced by the BBA, which is for interest rate swap, conventional interest rate swaps and forward rate agreements. There was an FX agreement, actually, the FIOBA or IFEMA. And about the same sort of, that was around, all of those are in the kind of mid-80s roughly, and around the same sort of time. Also, initiative from the US side particularly is what led to the birth of ISDA and ultimately the ISDA Master Agreement. And over time, by and large, not exclusively by and large in the conventional space, certainly the ISDA Master Agreement has become, the sort of the more prominent document, let's say. But the point is that, you are at a time in the conventional derivatives market where problems were being faced, which actually are very, very similar to the sorts of issues that are being faced, have been being faced over the last few years in the Islamic derivatives market. Namely, you've got a relatively small number of players, but others looking to participate. You've got, you've got still people, as a consequence, a lot of people working off their own bespoke documents. So from a kind of end user point of view, a corporate point of view, for example, if you're a treasurer at a corporate institution, you may talk to 3 or 4 banks or whatever, and you end up getting 3 or 4 different agreements to review and so on, and your legal resource is not that dramatic, so all of these things are actually almost barriers in their way to your being able to progress. Meanwhile, of course, the houses, as they deal with each other, have this battle of forms between themselves as to, well, I've got my agreement and you've got your agreement, and how we're going to kind of manage all of this. And all of this is what we've been seeing in the context of Islamic finance. It's really, I'll say, something that we've seen before, and I think what it really underlines is that the reason we are where we are today in the context of the Islamic finance market is a function of, actually, it's a very positive point, because a positive sign, because I think it's evidence of the growth of the market. And what's been happening over the last few years in particular is people bandy around, the $1 trillion number of the, scale of Islamic assets. We've reached $1 trillion or about to reach $1 trillion, and we're going north and all that. And all of that, to me, is saying that we have a market which has grown significantly, is of a significant size, and is continuing to grow. And pace of growth may go faster and slower according to the years and according to the economy more generally. But the point is, at the end of the day, we are on a growth trajectory, and we already have a significant size. And I think 2 things in particular are associated with that. One is just individual institutions, as they grow in scale, are bound to start having more and more structural mismatches in their books, because assets are of one kind and liabilities are of another kind, and the bigger you are, the more different sorts of assets and the more different sorts of liabilities that you have, and the more they are different, the more there is a mismatch potential in your book. And the question is, how are you going to address that? Well, first of all, should you address it? And that's something that we'll talk about in a second. But assuming you are going to look to address it, how are you going to address it? And indeed, I would say that if you don't address it, what is it actually going to constrain your growth, because you are carrying these risks, and there's only so much of that risk that you can carry. And the second element is the growth has also been a geographic growth. not just necessarily that, the bank in Dubai now has branches in 10 different countries, but it's the bank in Dubai has investments or customers in 10, 12, 15, 20, whatever number of countries it is. And the point about that is that brings currency risk with it, because, for example, a Bahrain bank lending on a project in Scotland, for the sake of argument, is reporting in Bahraini currency, it's lending in pounds, by definition you have a currency mismatch at that point in time, right? And the more international your activity, the more you're going to face currency mismatches. So really, I think the positive point is that this increasing demand that we've now seen and got to is simply evidence of the evolution, the growth, and an increasing maturity of the Islamic market. Why standardization? I've sort of covered some of those points. The cost of evaluating the documentation is more balanced and so on. It contributes therefore to efficiency and liquidity and to a degree certainty as well. Potentially even, if you really did have clear standardization, because it would make it easier to transact, hopefully it would actually reduce the cost of transacting and therefore to contribute to kind of equalizing the costs of executing, relatively between the Islamic market and the conventional market too, because we do obviously see a price difference between the Islamic market on a lot of products and the conventional market, and that's a function of, well, to a certain degree at least, is a function of the additional kind of infrastructure and execution costs that the Islamic market still carries with it. So things like standardization help address a number of those things. If you are designing standard documentation, what is it that what are the features that documentation should have that you wish to aim for? And I don't think that they are that complicated, actually. And again, the principles, I think, when applied in the context of Islamic finance are not different from the principles when applied elsewhere, with the possible exception of the first one, obviously, which is clearly, if you're going to develop documentation, you want documentation which is Sharia compliant. Again, that's not, obviously the Sharia compliance is unique to the Islamic finance market, but actually any market that you look at, there's normally something about that market which is sort of slightly unique to it. And essentially what it's saying is we want something that's fit for the particular purpose that we're developing this document for. So clearly in the context of Islamic finance, what we want to have is something that is going to meet and satisfy Sharia requirements. And I'm going to come on to, again, and I hope that by the time I finish, I've got across that I don't think that these issues have been particularly complicated. They've required a certain amount of work to deal with, but so I don't think they're as complicated as they're sometimes made out. So that's the starting point, in terms of trying to achieve standardization or standardized documents. Obviously, if you're developing documentation for hedging purposes, clearly it needs to produce provide the necessary hedge, and so I guess it's going to be built to develop that cash flow and so on. And towards the end of this, I'm going to talk about the profit rate swap documentation that's been developed, which and show you how, or talk you through how we've tried to achieve that in the context of that documentation. But, and I think these next two are important, you obviously want documentation that's enforceable, right? Clearly, what's the point otherwise? And clearly also, to my mind, and this is, you could debate this actually if you wanted, this last particular bullet, you could, to my mind, you want to develop documentation which is structured to optimize risk management and risk mitigation. And why I say that that's more debatable is because you could actually stop at the first three and have documentation where actually it could have done more to deal with risk, to manage the risk, but you take a commercial view that it's far enough and that actually need to go any further, and it meets your requirements to give a moment in time. and so you're not going to worry about kind of making it as making it as good as you really could do. And in a way, I think that's where the market has been in terms of individual houses. In other words, they've produced their own documentation in many cases. Obviously, it's been slanted in their favour, but in some ways, has it gone for the most optimal arrangements that you could do with these sorts of documents? Answer probably no, because the focus has been very much, well, we want to get documents which we can use in our hands, and we're really not looking to try and sort of deal with the marketplace as a whole. We're very much looking at it in terms of us and our some individual trades that we're going to do. And I think the market initiatives like the one that has been working its way through ISDA and IFM, one of the contributions that initiative makes is actually focusing also on that last bullet, which is to try and develop documentation, the standardized document, not just as standard documents, but also to say, well, actually, what's the best, what's the optimal that we can do? And in a sense, that's actually the bit that's taken the time in the documentation processes that we've been looking at with ISDA and IFM. A few words about Sharia compliance. First of all, as Warren just said, I've been around in the derivatives industry for a very, very long time. And every single day you open the paper and somebody's having a go at derivatives. Okay, every single day. I mean, that is not an exaggeration. I just pick 5 papers today. I guarantee you, somewhere in that lot will be somebody saying something about how bad derivatives are. Okay, and that's an industry that's been around for 30 years plus. Okay, so derivatives per se have a lot of issues around them, and a lot of those issues are, and a lot of that comment when you read it or hear it is not necessarily really to do with people who are understanding the individual products or understanding the individual uses of them. It's very much a more kind of general approach to life, if you like, and often it's using derivatives not necessarily because of the issues derivatives. It's there's a hidden agenda which is having a go at banks or whatever it is. Okay, so I say all of that to put into context the fact that there are also, as you all know, regularly discussions about the compatibility of derivatives and Sharia. That's a debate. Read the Islamic finance magazines, press, etc. Obviously, that's a continuing debate as well. But put that in context. It's in the context actually where the broader concept of derivatives, as I say, is itself continuously debated. Okay. Now, leave that to one side for a second. Simple examples. Okay, I'm a car importer in Dubai. I distribute Mercedes in the UAE. Okay, I buy them from Mercedes. I pay euro, obviously, to Mercedes. I sell in the UAE, so I sell in dirhams. Okay. So, year before last financial year, I bought X number of cars. I paid Y price for them, brought them across, transport costs X, Z, and then I sold them for A, and I made a profit. Next financial year, I paid exactly the same price for those cars. I had exactly the same transport cost. I sold them at exactly the same price. I made a loss. What's the difference? Obviously currency. It's a fluctuation in movement between the euro and the dirhams, right? Now, any number of conversations that I've certainly been involved in with the scholars, there's an acknowledgement that managing your, and by the way, clearly if you're a car distributor, playing the FX markets is not your rationale, right? I mean, you are a car distributor. You buy cars, you sell them. That's what you do, right? But to find yourself in a position where whether you make a profit or a loss has got nothing to do with your endeavours as such, and everything to do with external factors, is an important point in the sense of something that we need to all think about and consider. And if there are products available out there to you to manage that currency risk, so that actually you can avoid a situation where you're swinging from profit to loss year on year, despite your efforts being exactly the same and probably increasing, right? It has got to make sense for you to look at those products, right? And that's exactly, in very broad terms, that's exactly the conversation, the conversations that I've been party to with a number of the scholars who accept that actually risk management, prudent risk management, is a sensible thing for any business to be doing. And indeed, some of them, I think, will go further and say it's not just a sensible thing to be doing, it's actually a necessary thing for businesses to be doing. There are car distributors in the UAE, believe me, right? So this is not a made-up risk. This is a real risk, okay? And most of by and large, the cars are imported. So actually, that currency risk is pretty much every car distributor in the UAE, okay? So now, equally, take it, that example I gave you earlier on of a bank in I'd say Bahrain, investing in Scotland. Actually, I didn't make that up. That is an example that has been given to me by one of the Bahraini banks that I've been talking to over the years. They actually did fund a golf project in Scotland, a golf course in Scotland, and they're taking currency risk, and they're saying, how do we manage this currency risk? And equally, if we don't manage this currency risk, that's not sensible, that's not good business for us to be doing, especially as it's not hard to manage that currency risk. There are products out there that we can use and we can access to help us manage that currency risk. So, at the end of the day, I think the critical thing, when you're in terms of sort of the messages that come down from the scholars, if you like, come through from the scholars, is, if you are hedging actual risk, that's okay. That's important to do. It's important to understand and to do it properly. And the emphasis really is on you must be trying to deal with actual risks that you are carrying. But if that is what you are doing, that there's nothing non-compliant about that. If you're speculating, obviously that's a completely different story, and that's not acceptable. But if you are addressing actual risks that are being carried, then that is a prudent thing to be doing and appropriate. And as I say, certainly in important scholars' views, a necessary thing to be doing. You must have real transactions. We all understand that in order to implement some of these strategies, we need to enter into transactions. Those transactions have to be real transactions, not just transfers of cash. You're all familiar with using Muraba, for example, as mechanisms for real transactions. At the end of the day, we have to have real transactions taking place. Real transfers of ownership, real transfers of risk, and real payments. Okay. Asset must be halal, obviously. No interest rate, no interest being charged, obviously. Okay. Now, those, by the way, that list, it's a paraphrase, but it is actually the exact list. If you go to the ISDA website or go to the IFM website, when they published the Tahawut Master Agreement, the Islamic Master Agreement, accompanying that publication was a publication of a 3-4 page explanatory notes paper, and in that explanatory notes paper is a section on Sharia compliance, and the guidance that was given by the scholars, the IFM panel, on appropriate use of the documentation, or the context in which there would be an appropriate use of the documentation. And those items essentially are exactly the items that they said. So, although I've tried to, say it in as simple as terms as possible, actually it is fundamentally simple. Basically, if you're hedging actual risks and doing real transactions, and obviously not speculating, no interest, then then you're okay. And by and large, if you look at many industries, those principles in a way, I mean, I can leave aside the interest point for a second, but many investing bodies have very similar principles underlying them. For example, insurance companies and asset managers for a long time, insurance companies itself, the law has changed a little bit now, but in many countries, including this until very recently, the only authorized derivative activity for insurers was hedging. Okay? They were allowed to enter into derivative transactions for hedging purposes, because that was regarded as an appropriate thing to do, not for speculative purposes. Go back many years, the famous local authority cases in the UK, what were they about? They were about what was the capacity of local authorities to enter into derivative transactions. Answer, they were allowed to hedge, but they weren't allowed to speculate, and the problem was some of them had gone into the speculation territory, almost using the derivatives as an investment product rather than as a hedging product, and that was the source of the problem. So the principles that are there, although they're in the context of the Islamic finance industry, and obviously have some elements like the no interest element, which is clearly particular to the Islamic finance industry, the basic principle of using derivatives for hedging purposes is actually a very, very widespread investing rule, if you like. I've kind of covered that. Those are actually basically the examples that I gave you a few minutes ago about looking for hedges. The second one is actually that's the card distributor, the FX risk. The first one is a profit rate swap, where basically again you have somebody with a sukuk liability, which is floating rate, and who wants to fix that, and you have on the other side somebody who's got a lot of fixed assets, who's looking to diversify his assets for risk management purposes. So I'm not going to spend too much time on that. I want to spend a little bit of time on structure to be enforceable. So when you remember, one of the things I said in the features of when you're trying to design these sorts of products, what are the features that you're trying to achieve? One element clearly is you're trying to achieve something that is enforceable, because otherwise, in a sense, what's the point of it? But that does raise particular aspects or particular issues in the context of the work that we were doing on the Islamic documents. And what you will find is that the documents that have been generated so far, both the master agreement, the Tahoe master agreement, and indeed the profit rate swap confirmations that have just been published, are all use what I'll call the WAD technology. They all use WAD. There's the undertaking or the promise. And why do they use that? Obviously, WAD are an accepted tool in Islamic finance. Again, I'm not saying that that's absolutely universal. It does depend, but broadly speaking, WAD undertakings are acceptable and are regarded as something that, if you do give a WAD, if you do provide a WAD at the undertaking, then you're required to honour the undertaking which you have given. So in that sense, it's something that is binding on you. And obviously, with that, to structure it as documentation-wise in a way which is also contractually enforceable, brings you together to produce a product which achieves your desire for enforceability. Because there are other ways which, from a Sharia point of view, would be perfectly okay, like agreeing to enter into a series of murabba, whatever, and we do see that happening. The difficulty with those, or that structure, is that when it comes to enforceability, contractual enforceability, that does raise issues, and so certainly for the moment, the path that we've gone down has been around the WAD because of the better ability to achieve contractually enforceable documents, which are also Sharia compliant. That has given us as an opportunity. So. I'm talking broadly contractual enforceability there. I've got a note about insolvency and enforceability, and I'm going to come back to that in a second. And then structure to optimise risk management. And this, as I say, I think this was the extra, if you like, that the initiatives through the association did need to focus on in terms of, if we were going to develop documentation, it wasn't just that we were going to develop standardized documents, it was actually that we needed to, the opportunity needed to be taken to develop documents which are not just standard and not just enforceable, but actually, as optimal as possible in terms of the risk management and risk mitigation techniques that they use. And that, again, it was not hard in one sense because things like the ISDA master agreement, many other master agreements in the industry have already gone down this path, and if you look at what is it that the master agreement is giving you, what it's trying to do is obviously maximize the risk management capacity of the document. So, for example, where you have a whole series of transactions with a particular counterparty, in a sense, because of that series, you've got an accumulation of risk between the two parties. But on the other hand, individual transactions will have relative values, and you're going to have some, in the way of the world, if you are just, if you have a kind of normal portfolio, if you like, or a normal book, you are going to find yourself in a position where some of those transactions will be in the money for you in your favor, and some of the transactions will be in the money for the counterparty. And the point about that is that inherent in that relative value is an element or is an opportunity for risk mitigation, because if you look at each transaction individually, it will pay, or it will, the liability is whatever the liability is, the asset is whatever the asset is. But actually, if you step back and look at it as a book, then the aggregate value of it, because of the netting capacity, because of the offsetting that's built into looking at it as a book, is going to reduce the liability and reduce the asset size. So inherent in that approach is a risk management tool, and that's at the heart of master agreements generally. And so clearly in developing the documentation that we were working on, trying to achieve that was one of the standards that we were seeking to achieve. And so the TAWIT master agreement is a master agreement, governs all transactions. The confirmations, like the PRS confirmations that I mentioned, sit under it, and the principle of it is that, in the event of a default or various other events, you can terminate through the agreement itself and the provisions in it, you can terminate all of the transactions, close them all out, net, and hopefully reduce the position of the parties to whatever the net number is between the two of them. Now, we've done what we can from a contractual point of view, and in a few minutes I'll also talk about how we structured that from a Sharia point of view, which did take a bit of time, by the way, but we have to face up to the fact that at the end of the day, the enforceability of all of these things, like any document, like any contract in an insolvency, does depend upon the insolvency law that's relevant to it, and if you're involved in the derivatives industry, you'll know that there's a lot of focus on netting, getting netting opinions and all of that, and all of that is simply about verifying enforceability in an insolvency situation of the documentation, where it's got a whole series of transactions under it. And if you are involved again, you'll know that the worldwide picture is that, there are many, many places around the world where insolvency laws either have always been structured in a way which would recognize the effectiveness of netting mechanisms and closeout mechanisms, and other countries where they historically haven't, but the law over time has changed to allow recognition of it. But a lot of the jurisdictions to which Islamic finance is relevant, unfortunately, are not in that situation. And mainly because insolvency law itself, corporate insolvency law or personal insolvency law, is actually itself quite an undeveloped thing, and as a consequence, enforceability in an insolvency situation is, by no means certain, and in a number of cases clearly not feasible. So, in a way, again, just to not get too kind of excited about, or too overexcited about what we've achieved by developing documents, you have to look at it in context. We've taken a step. It is an important step. It is a necessary step, but it's not the end of the story by any means, because there's also a lot of work to do, again, which both ISDA and IFM are, plug away at. both in the Islamic context with this, but also in this case, more broadly in the conventional context as well, where it works hard to try and persuade legislators, regulators, others to change their laws where necessary in order to enable enforceability in an insolvency situation. Russia being an example where laws recently changed, but that took us a long time. For a lot of again, the problem with the former Soviet Union countries was very similar, that they didn't, the nature of communism, they didn't have personal insolvency laws or corporate insolvency laws, because that was kind of antithetical to communism. And now over time, as those countries have developed insolvency laws, and slowly work has been succeeding in getting recognition for these sort of risk management tools to be embedded in the law. If you go to the Gulf, there is no country that I know of in the Gulf where you can safely say that in an insolvency situation with a corporate based in that jurisdiction, netting will be recognised. Other countries like Malaysia, like Singapore, like Indonesia, are some of them are in a better position. Malaysia has a relatively good position, although it's not completely 100%. Singapore is relatively good. Indonesia is a bit more debatable. But the point is, the countries where Islamic finance is obviously much more active, we do have this backlog issue that even when we've got the documentation in place, in terms of just risk management, you also have to worry about and manage and consider the risks of your counterparty becoming insolvent, and there's a way to go in getting there on that. So then a few minutes now on the Tawhid Master Agreement itself. As I've explained, it's a master agreement, it's a multi-product agreement, and it's a framework which covers, or so it sits above an umbrella which sits above all the individual transactions that you would do. It has closeout and netting, which I've been talking about, as a mechanism for trying to aggregate and maximize that risk management opportunity. Just as for the techie, the documentation techies amongst you, there are other little techniques which sort of assist that as well. The fraud asset technique, the single agreement technique, they're all in there. Again, they're all in the ISDA if you look at it. And by and large, the TMA is very much based on the ISDA. And that was also partly because why reinvent if something's already there? But also, if you look at the document, it's actually, if you look at the clauses, the sections and all the rest of it, they look very much, the layout is like the ISDA, and the section numbers pretty much, and headings and so on follow the ISDA. And the point of that was also that there are a lot of people out there who are very familiar with ISDA now, including a lot of the Islamic institutions or people with Islamic windows, and the whole point of making this in that shape was to help, to make it easier to use, because people are already familiar with ISDA. They have their policies, actually they can piggyback off that and start using this document more easily. So it was a deliberate policy to try and make the document as user-friendly as possible, from the point of view of a lot of the people who would be using it. And the closeout and netting section is section 6, and I'm going to come on to that in a session. I just want to say a little bit about governing law and dispute resolution. In the agreement we have, if you look at the governing law clause itself, there is no reference to Sharia in it. Elsewhere in the agreement, in the representations, each party represents that to the extent that Sharia compliance is relevant for it, it has obtained its own internal approvals necessary to enable it to enter into the document and indeed enter into transactions under it, with the appropriate kind of Sharia fatwa or approvals of its advisors or its board or whatever. And obviously, if that isn't true, then that's a misrepresentation. And a misrepresentation, by the way, is an event of default, not that one, but also other representations as well. So, although it's not uncommon to see governing law clauses which try and bring the Sharia into them, we had a conversation quite early on with the scholars to try and understand what was the best approach for this. And the point that they made when we discussed it was the following. They said, number one, you should not enter into an agreement, if you're an Islamic institution, you should not enter into an agreement unless you are satisfied, having gone through your own internal processes, whatever they are, it's a corporate governance aspect almost, whatever that internal process is, you should go through that to make sure that you and your scholars and your board, etc., are satisfied that what you're doing is Sharia compliant. Once that has happened and you sign up and you have started undertaking obligations, those are your obligations. You do not back off those obligations. They are binding on you. Right? And it may be that in a year's time or 3 years' time or 10 years' time or whatever, your board, or you might reevaluate some of it and may say, actually, you know what, those transactions which we have thought have been okay, now we're not quite so sure, what's the impact of that? The answer is not you then back off all of the obligations that you've entered into. Sorry, those are obligations and you have to fulfill them. What it means is that you don't enter into any more of those, because obviously doing any more will not get the Sharia approvals that you need, and therefore you shouldn't do it. And that's very similar, if you all recollect, to the situation we all saw with Sukuk. Remember a few years ago when we had a lot of Sukuk issues out there, then there were questions asked about their compliance. What that meant was not the Sukuk that had been issued were terminated or redeemed. What it meant is people didn't do any more of them, and we had that conversation with the scholars early on. We actually had that conversation again at the end, towards the end, said, because it was something like 3 years gap in between the two conversations, and we said, are you really comfortable about that? And they were absolutely clear. There was no single dissent on that. Once you have entered into an obligation, obviously, you should only have done it in good faith on the basis that you understood it to be Sharia compliant and had been through your own internal process. But once you take on an obligation, you must comply with your obligations. And so including the Sharia in the governing law clause actually is not an appropriate outcome, was the result of that conversation. And indeed, having an event of default or a termination event, which is, the Sharia has been looked at again, was also equally not an appropriate approach, because, once the obligation is there, it needs to be complied with. Early termination, there's a lot of stuff in this which I'm not going to go through in detail. Basically, it took us a long time to get through this bit. And the key aspect of it was the fact that, and I go back to the point I made earlier, which is that when we were developing these documents, what we're trying to do is produce documents which are optimally valuable to the marketplace. And one element of that was regulatory capital. In other words, we want documents which, from a regulatory capital point of view, as well as just from an enforceability point of view, are as valuable as they can be. And I'm sure you're all familiar with netting and regulatory capital around netting and the advantages of that. To be able to achieve those advantages, if you look at the capital rules, they require not just an enforceable agreement, so that you can claim against your counterparty. They also require an agreement or arrangement where if you're the non-defaulting party and you're out of the money when it comes to a closeout termination, you have to pay, you are obliged to pay. And actually structuring that last bit was a real exercise and took a lot of explaining, and fundamentally the mechanism that we developed to achieve it was this thing called the Musama, where what you'll find is there's a Musama, which is a sale and purchase transaction, built into the master agreement. And essentially the mechanism is that, if there is a termination, I've entered into these transactions with you, I've entered into them because I have been hedging, that golf course I've invested in Scotland, or, the euro that I need to buy those cars from Mercedes or whatever. And if you are my counterparty and you have gone bust, for example, we've had to close out, I am now unhedged. I'm going to need to go back into the market to get new hedges. That's going to cost me money in principle. And essentially we created an index. We valued, we looked at what the aggregate amount of that cost was to you, and treated that as an index and used that as the basis for the purchase price under the Musama transaction. But if in fact the market had moved in your favour, so actually it was cheaper for you now to get the new hedges in place, so actually you were making a gain, then again that flows into this index that we have, and in fact what it does in documentation terms is it allows the defaulting party to exercise a wad which you have given to enter into a Musama transaction, and the price of that Musama is essentially going to give him the gain. So we ended up, and again this is, you see this in the conventional market documentation, but you also have it now in the Islamic documentation. You have a mechanism that on a closeout, it's not just the cost or the damage that's recoverable or payable, it's the gain as well that is recoverable, even if that's owed by the non-defaulting party. And I say that was very deliberately included in order to facilitate the regulatory capital treatment of these transactions. So then a word about the PRS structures, property rate swap structures. They use Murabaha, so in other words, when you have those floating profit rate flows or fixed profit rate flows, the mechanism that's used to get them across from one party to the other is off the back of a Murabaha transaction. Again, the scholars are very clear that you need actual transactions, real movement of assets, real movement of money, real movement of risk. All of that is built into it. It's the obligation to enter into Murabaha is based on the wad that the party is given. So each party gives a wad under its, depending on the flow it's to provide, and then. Just so you know, what we've tried to do is generate documentation which allows people to implement these transactions either by actually having two sales, the sale which generates a fixed rate leg and the sale that generates the floating rate leg, or as we are increasingly seeing in the market, because again this is a risk management tool, a single sale which is for the, which is a sale where the profit element is the difference between the fixed rate and the floating rate. We've allowed for that, and we've also allowed for, in terms of timing of when you enter into your Murabaha, do you do it at the beginning of a calculation period or the end of a calculation period? Again, we've built that flexibility in so you can do it according to your systems basically and the approach that you take. So that's it. I'm sorry I rushed the last bit of that. A little bit, and I'm happy to take questions. But again, just to sum up, I think just what I say is I think, to my mind, what we're seeing is a market which is growing, and its growth is bringing the need for these sorts of products with it because they are risk management products. Risk management and hedging is normal across the board. It's normal for Islamic finance. It's normal in the conventional market, and actually limiting yourself to risk management and not speculate also is a perfectly normal thing, both in the Islamic finance market but also in the commercial market as well. And that fundamentally is why I think these products are perfectly acceptable. And I say that's been the discussion that's come out of the meetings and the discussions that we've had with the scholars. And then in documentation terms, we've not been trying to, we've had to structure it a little bit to make it work from a Share point of view, but we've not been trying to achieve things that actually aren't exactly the same things as anybody's trying to achieve when they're developing standard documents. And I hope I've explained to you what those are. So thank you very much.